When we gain even the smallest glimpse into the world of finance, our minds are naturally tuned to think about investing, and that's a positive inclination. However, before embarking on your investment journey, it's crucial to analyze the type of investor you aspire to be. Do you aim to become a skilled investor, or are you simply seeking a slice of the investment pie? If you resonate with the former, I strongly encourage you to stay tuned until the very end of this video. We will be sharing a set of do's and don'ts that every successful investor abides by. These principles and methods draw inspiration from none other than Benjamin Graham, widely regarded as one of the greatest investors of our time, alongside his student Warren Buffett. Now, let's delve into the essential characteristics possessed by every intelligent investor. To become an intelligent investor, it is essential to maintain a healthy skepticism towards the market. Imagine treating the stock market like a woman, appreciate her beauty, but remain cautious of her unpredictable behavior. Many of her actions are short-lived and tend to exaggerate things unnecessarily. If you desire a long-lasting and serious relationship with the market, you must learn to ignore her occasional outbursts. Just like the stock market, prices can skyrocket to insane heights one moment, only to plummet to conspicuous lows at other times. But how does this happen? As mentioned before, the market suffers from mood swings, capable of flaring up at any given moment. This is why you witness stock prices for a highly anticipated gadget soar before its release, only to come crashing down afterward when it fails to meet people's expectations. Intelligent investors don't rely on speculation or guesswork. Instead, they base their decisions on thorough research. They understand the importance of self-analysis and recognize any shortcomings that may hinder their investment success. By focusing on discipline and avoiding poor investment habits, they maintain a steadfast approach to their financial endeavors. Intelligent investors steer clear of over-diversification. As Warren Buffett once said, diversification can be viewed as protection for the uninformed, making little sense for those who know what they are doing. Generic advice urging extensive diversification doesn't guarantee loss limitation, it often hampers growth potential. Trying to fully comprehend 100 companies is unrealistic, leaving insufficient time for thorough research and confident investment choices. Instead, opt for a focused approach. Choose a maximum of 5 investments and dedicate yourself to understanding every aspect. Over-diversification signals mediocrity, which intelligent investors avoid. They refrain from spreading themselves too thin, avoiding the temptation to dip their fingers in every pot. Remember, it's quality over quantity when it comes to building a robust investment portfolio. By being selective and knowledgeable, you enhance your chances of success. Intelligent investors understand that their emotions can be their greatest enemy when it comes to investing. To counteract this, it's crucial to establish a solid investment formula and adhere to it unwaveringly. By doing so, you create a necessary barrier between your emotions and your investment decisions. One well-known approach, referred to as formula investing by Graham students, is commonly known as dollar-cost averaging. As a wise investor, you must set a fixed budget and allocate a specific amount of dollars on a monthly or quarterly basis to your investments. This disciplined approach requires you to consistently purchase more of a stock you have previously chosen, regardless of its current price. Emotionally, this can be challenging, but it is a necessary sacrifice in order to become an intelligent investor. Moreover, it acts as a safeguard against potential losses that may result from investing a large sum all at once. Intelligent investors embrace and apply the 3 fundamental principles of investing, as advocated by the legendary guru, Graham. Firstly, conducting thorough research is imperative before investing in any company. Analyze their principles and performance over the past decade to make an informed decision. Secondly, diversify your investments to safeguard against potential losses resulting from the monotony of your portfolio. Lastly, prioritize investments that offer steady and gradual returns over those promising extravagant profits. These principles are easily comprehensible and can be applied by ensuring comprehensive investment analysis. Focus on identifying the gap between a company's present price and its potential future value. Select 3 or 4 companies to concentrate on, thereby mitigating losses in case of unforeseen circumstances. By diversifying, you protect a substantial portion of your investment eggs from being concentrated in a single entity. Intelligent investors prioritize capital preservation above all else. Their primary objective is to minimize losses without compromising potential capital gains. This means they focus on preserving their investment capital, even if it means breaking even with incurred losses and profits, ensuring the initial investment remains intact. Consider it as the creation of a safety net, commonly referred to as having a margin of safety. These investors seek investments with minimal risks, avoiding those with high possibilities of being risky. Their main goal is to avoid losses, though it doesn't imply avoiding all types of risks. Rather, they steer clear of risks that could result in significant losses. Smart investors don't compare their returns to the market or overall economic performance. Instead, their aim is to achieve a positive return each year, regardless of the circumstances. They prioritize tangible results over outperforming market indices. Their mindset is limitless, always striving for success. Spotting an intelligent investor becomes apparent when they safeguard their investment capital by acquiring securities with a substantial safety margin. If capital growth occurs as a result of this approach, they perceive it as a positive outcome derived from their strategic methods. Intelligent investors disregard market fads and rumors that circulate about supposed game-changing investments. Take, for instance, the crypto craze, where speculative claims suggest it will render paper money obsolete and bring about radical changes. Such talk lacks substantial evidence and should be treated as pointless noise. Instead, adopt the mindset of an intelligent investor who acknowledges the uncertainty of the future. Recognize that unforeseen events, such as a pandemic, can significantly impact various investments, including cryptocurrencies. Prepare yourself mentally for whatever lies ahead, as there won't be glaring red lights warning you of imminent danger. Stay focused and committed by continuously educating yourself about these market frenzies. This knowledge will keep you informed about the developments and help you anticipate potential outcomes. Intelligent investors understand the value of letting opportunities pass them by. Have you ever wondered why the most renowned investors don't sell their stocks simply because the price tripled overnight? Most individuals would frantically rush to their brokers and banks, trying to cash in as much as possible. However, these average investors are far from reaching the elite status of successful investors. The key difference lies in the virtue of patience. Intelligent investors recognize that it's unnecessary to seize every opportunity that comes their way to generate a solid return. By exercising restraint and allowing opportunities to pass them by, these investors preserve their capital, avoid hasty decisions driven by emotions, and position themselves for more favorable investment prospects in the long run. Intelligent investors possess the ability to think quickly while maintaining composure when making decisions. This sets them apart from other investors. While market indices may plummet, they remain calm while the rest of us succumb to panic and make impulsive choices that prove costly in the long run. Fortunately, there are still opportunities to profit, even when your perspective differs from the consensus. To persevere in investing, it's crucial to recognize the intrinsic value of your investments, even during challenging times. If you had valid reasons for selecting a particular investment, a declining price should not deter you, especially if you firmly believe that the situation will eventually turn around. Moreover, your decision should be grounded in thorough research. During turbulent periods, it is essential to be courageous, as no one can consistently time the market perfectly. This uncertainty is what makes investing captivating. Embrace the unpredictability and hold steadfast to your well-reasoned convictions, even when faced with market fluctuations. By staying resolute and trusting in your research-backed choices, you position yourself to capitalize on opportunities that others may overlook. I highly recommend reading The Intelligent Investor by Benjamin Graham. This book delves deeply into the traits discussed in this video while shedding light on common investment mistakes. Unlike overly hyped or dull reads, Graham's book provides timeless wisdom without making unrealistic promises. It appeals to both curious 16-year-olds seeking investment knowledge and individuals over 30 who will be amazed by the secrets it reveals. If you have already read The Intelligent Investor, feel free to share your reviews and insights in the comment section. Thank you for watching. Don't forget to subscribe and leave a like for the YouTube algorithm. Have a fantastic day, and see you in the next video.